Thank you everyone for joining us this morning. I'm going to take you through a brief overview of Pioneer Credit, who we are, what we do, and why we exist in this market and in the markets we participate in. A little bit about the size of our business and the opportunity set that sits in front of us, and of course some of our financial performance, and then update you on our outlook for this year and what it looks like in 25 and 26. So a little bit about us. We're a debt recovery business, but we specialise in acquiring and servicing what are retail purchase debt portfolios. So what that means is we don't act for anyone else in the sense that we don't collect on behalf of third parties. We buy portfolios of impaired credit, predominantly off the big banks and the non-bank lenders. And we bring them onto our platform, and then we service those consumers ourselves and for our financial benefit. As I said, they're all held on balance sheet, so everything we get, we own, and we bring that in. That builds a lot of resilience into this business, particularly when you go through periods of disruption like we did through COVID. We have no exposure to the Northern Hemisphere. We're an Australian-centric business. There's an incredible growth opportunity that exists for us here. We're the number 2 player in this market by total investment, probably the number 1 player in the banking and finance market, but there's a huge opportunity for us to continue to grow market share in that particular part of the market. Since 2008, we've invested almost $750 million into these purchase debt portfolios. So that's an incredible amount of money that we've invested. We've been very successful. That's across about 5.6 billion in receivables and 720,000 customers. So that gives us this incredibly broad data set from which to build our business, look out for our business, and to use that to price portfolios and all the things that are important when you're thinking about a financial services business. We currently have an active base of about 210,000 consumers across just over $2 billion. And of that, about $450 million are performing. So these are customers that are paying us on a weekly, fortnightly, or monthly basis, just like a performing loan book in a bank. And really importantly, you know, this goes to the heart of why we exist. We talk here, our people are founded in good and they have a strong social conscience. Our business since inception has always understood the importance of the consumer, the need to treat consumers well. And this has become very relevant in banking and finance in recent years. And as a leader in this part of our sector, we're very much valued by the vendors, the people that we buy the debt from. In terms of our market, our position is really structured across 4 key elements. First of all, we have a unique servicing approach. Pioneer works really closely with the customers it buys. The people that we buy and we bring onto our platform have had a life event: death, divorce, sickness, might have lost their job, domestic violence. They've had an event that's caused them to not be able to pay their particular account. We work with them over time to get a good outcome for them and a good outcome for us and our originators. And that's very unique in the way that we go about that approach. We are one of the few scaled participants in this sector. Scale is very important. This is a very expensive business to run. We have very tight compliance and governance obligations, which are really important, but they're very costly to implement and to audit. And as a business, scale is very important, the way we bring in data into our business and so forth. So we're one of the few scaled participants in this sector. We have a market-leading reputation. This business is not driven, or this sector is not driven by the price someone pays for portfolios. It might have been in the past, much more skewed that way. Now the world's changed dramatically, and the banks and the non-bank lenders want to be dealing with a group that has a market-leading reputation, that will treat consumers right, that will protect the brand of the originator. And Pioneer's got a very strong and enviable reputation in that regard. The other part is we do not offer further credit to customers. So we buy these consumer accounts, these consumers get healed, but we don't compete with our vendor partners, unlike some others. And because of that, we're getting more opportunities than what others are seeing. So in other parts of our market, groups are talking about contraction and market shares getting difficult for them. A large part of that is because they compete with the people that are selling the portfolios. Pioneer doesn't do that. So we're aligned to our vendors in getting good consumer outcomes. In terms of market activity, macroeconomic, everyone's concerned about cost of living and interest rates. As far as it goes to consumers and to retail credit, they're performing remarkably well. We remain fully employed in this economy. Australians have this very strong sense of obligation when it comes to meeting their financial commitments. And I think we're seeing that come through, not just in Pioneer's results, but in the bank results and the non-banks with the low debt levels. In terms of our market, regulatory and reputational issues are really creating a moat around this business and making it very difficult for new market entrants. That's a good thing for us. And vendors are selling more, but they're being very selective. They're preferring to partner with groups that have got strong relationships with them, such as Pioneer. And from a competitive perspective, there have been a range of market exits over the past few years. We're really down to a duopoly in terms of the banking and finance market, and that's really healthy for our business. And there's a few more opportunities that exist there, as there are with mergers and acquisitions. And as Pioneer continues to build its business and continues to build the value back in its equity, these are opportunities that we'll be able to avail ourselves of. In terms of investment, so we're in a business that invests about $85 million a year in portfolios, as you can see over the last 3 years. We've got the historical context there as well, and you can see from 19 to 21, things peeled off through COVID. But we're back to 85 million. The business grows once it's spent or invested about 65 million per annum. We think we can grow this to 125 to 150 per annum over the next couple of years on a run rate basis. So really healthy outlook for us. Importantly, we're buying at better than historical IRRs across our FY24 vintage. So whatever we've bought this year is at better than historical IRRs. And I think that's reflecting a couple of things. One, again, is our superior servicing arrangements and our enviable reputation. Two is part of the shrinkage of the market. And three is this desire for people to partner that are partnered with them, and they're prepared to pay a little bit more for that. And that makes sense to us. One of the ways we demonstrate very, very clearly to the market about the way we look after consumers is through Net Promoter Score. And if you think about our business being debt recovery, this is where we ask people, how likely are you to refer Pioneer to a family or friend? We have a Net Promoter Score of plus 23. It's a remarkable score and has been relatively consistent over the last couple of years, but really reflects how well we look after consumers. And you can see through there, at first contact, the score's minus 40. So this is the time we buy the account from the bank or the financier. And as we work through those cohorts, the scores increase quite dramatically. We measure every interaction with a consumer. So the score of plus 23 reflects what all of the consumers, happy, sad, excited, energized, what all of them think about Pioneer. And it's a really important part of how we demonstrate to our vendor partners how good we are at our job and how we differentiate ourselves, and also how we keep a track on ourselves of how are we actually going, how are we engaging with consumers, and are we actually looking after them in the manner that we say we will and the way that we intend to. In terms of our portfolio, we have an opportunity set of about $2.1 billion. So that's the total amount of receivables that are owed to us. And of that, it's broadly split into two parts. We've got a performing portfolio that's been growing at a CAGR of about 10% over the last sort of 4 or 5 years. That's about $450 million. So these are customers that are paying us on a regular basis, just like a normal performing loan portfolio. And we get about half of our monthly revenue from that. And then we have our WIP. So these are customers that we're onboarding and then working with them to improve their situation so they can commence meeting their financial commitments. That's about 1.7 billion. And we get our other half of our revenue through here. Some of those customers become performing and we grow that book, and others pay us in lump sums or sporadic type payments. The deeper we can dive into that book, the deeper we can reach into it by using better analytics, leveraging our scale, will result in even better outcomes for our shareholders in the years to come. I think one of the things that really separates Pioneer from most every other small financial in the market is our alignment to shareholders. It's not just that we are the largest shareholders in the company. That's a really critical part, but it's actually about the way incentive works in our business. No one in my leadership team or my executive receives a short-term incentive. The assets we buy pay us back generally over a period of about 4 years. And as such, it has always been the case that we only run a long-term incentive program that pays out now over 4 years. So there are 3 yearly targets that are set. And then if those targets are met, the incentive rolls forward, and then they must hit a 4th target for those incentives to be released. The program that we're in currently requires us to deliver a statutory net profit after taxation of at least $18 million in FY26. So if we deliver that, then these incentives are unlocked for our team. This ensures that I've got a team that is motivated for the long term, that when we invest money in these portfolios, we are thinking about long-term outcomes, not about hitting a short-term hurdle. And I think that alignment is very, very, very important to shareholders and separates us from most everyone else. Of course, $18 million against our current market cap looks quite remarkable, but it's a target we fully expect to deliver upon in 26. In terms of our financial performance, this is for the first half, so extrapolate it across the full year, and I suspect you get to a reasonable expectation of what this business should be delivering. $75.6 million in collection, so that's the actual cash that we received in the first half in our business. EBITDA, not a great measure in financial services businesses, but one that so many people understand. None of these numbers are normalized. This is just straight out traditional definitions. $49 million. So this is a highly cash generative business. EBIT, just shy of $18 million. The delta being our interest costs, and I'll get to that in a minute, but $18 million of EBIT and a small net profit after taxation for the period. It was the second half in a row that we've delivered an NPAT following some the corporate activity that beset this business in 2020. In terms of our profit and loss, you'll see there a relatively simple business in terms of how it runs. The biggest expense lines really are employee expenses. They rose a bit through compared to the prior half. There's about $1 million a year in non-recurring expenses we expect to be able to pull out as we bring the end projects and other parts of our business that are occurring over the course of the next year. Amortization. So this is kind of like the cost of goods sold concept. If you think about that, we buy a portfolio for $1. If I collect some money, I must have a charge against that, and that's our amortization charge. And ultimately, it's our interest expense. We're currently paying about 13% for our interest. We expect that to drop dramatically by the time we complete our refinance, which is expected to occur before the end of this financial year. And that is going to save us somewhere in the vicinity of $8 million per annum. And that drops straight to the bottom line. So we're a business that's got great growth opportunity in front of it, a reducing cost base, and one that collapses immediately upon refinancing our senior facility. We remain exposed to the BBSW cash rate. So if interest rates come down, then that'll be a bigger saving for us. Net assets of about 43 million at the moment. There is also a deferred tax asset that is not on the balance sheet currently of about $25 million. So that will come back on board, and we've obviously got a good period of time where we're not going to be paying tax. In terms of our outlook, few things to mention. First of all, we raised $10 million in March. As we go through this refi process, we didn't want to draw down more debt. We raised $10 million at a premium to market. Doesn't happen very often. And that supported us growing our portfolio. There's a huge opportunity there for us. There are 5 main things that we're focused on. Continued industry regulatory focus. We've called this out for a number of years now. That's a really good thing for this business because it builds out that moat around us, something we like. Strong tailwinds for investment opportunities. We upgraded our guidance. We started at 60 million at the beginning of the year. We upgraded it to 85 in late last year, and now we've upgraded to an investment of $95 million just earlier this month. That provides us with good growth going forward, and there's a lot more opportunities. We've got agreements in place with 12 vendors at the moment. We've got a 5-year agreement in place with the CBA. That's a beautiful way to underpin our business, and there's significant opportunities coming to market. Reduced cost of funds. Nomura, who have financed us in the past and also are a substantial shareholder in the business, are exclusive arranger for our senior finance facilities. As I said, we expect that to close this half with material savings to be realised immediately for us. Realise operating leverage. Important part is you get to scale, you need to make sure you continue to pull out cost. We've got a core system replacement where we're re-platforming our business. That's well progressed. We're sort of 2 years into that now, and that'll be completed relatively soon. That will deliver great efficiencies for us in FY25, and there are other cost out opportunities for us, again, as we continue to scale. Finally, material uplift in NPAT. There's great supply of portfolios for us into a fully employed environment. We expect significant savings to flow through next year, which will, drop straight to the bottom line. And as I've said before, we've got an LTI target for FY26 of an NPAT of at least $18 million. So that's what we're fully expecting to deliver on. That concludes my formal part of the presentation, and Mark can open the floor to questions.
Yeah, thanks, Keith. The questions have been coming in thick and fast there as we're running through the deck. So let's jump into them. One, I want to touch on the refinancing because you called it out there. A question around the refinancing gets done. Let's just assume that timing we'll see what happens. Could be, as you say, you're aiming for the end of this financial year, but even if it falls into the early part of next year, dividends, if it comes back into play, once that refinancing, is that part, or is the plan that frees up a hell of a lot of capital that can be redeployed into PDLs? Maybe just give us a sense of what the board is thinking once the refinancing is done and dusted.
Of course, Mark, thank you. Look, I mean, historically, this has been a business that's been a very strong dividend payer. In 2018, I think we were making $20 million NPAT, and our previous policy was that we pass through 50% of our divvies, 50% of our profit is fully franked divvies. We'll get back there. look, I don't expect that we're going to do that in 25. It's an option available to us, but we're also staring into an environment with incredible opportunity. And I can't see at the moment that passing through dividends is a better use of the capital than investing further into the market. The other part about that is the points at which we're investing now are very accretive. So it's reducing our leverage, which over time will also reduce our cost of funds. So we need to balance that. But we're alert to dividends. You know, I'm the major shareholder of the business. I'd certainly like some dividends as well, but we need to balance that across what's good for all of the shareholders and the health of the business. And I think at least for the next year, we should expect that that's going to include just continuing to reinvest in good accretive opportunities.
And then a question on maybe just you mentioned you're the number 2 player. The size of the PDP market or I think they meant PDL market here, that PNC plays in, it's kind of overall size, and where is kind of a natural ceiling for your annual investment amount? Let's assume refinancing is done, and we maybe look at on a medium term basis.
For sure. So the market's about 350 million this year. It probably grows a bit more next year, I think. So think about it as a $400 million market. About a quarter of that we don't play in. So we don't do anything related to payday loans, okay? And we don't do anything related to sort of lower quality credit. Currently, we don't play in we don't participate in the utility and telco sector. So the part of the market that we're in currently is, in the vicinity of 300 million. We think we can capture somewhere between 125 and 150 on an annualized basis and rolling basis without having to reduce margin. And that's the way we think about our business. We don't need to be the biggest. Our goal is to be the most sustainably profitable. So that means getting to the right stage or the right size of market and right size of market share and repeating that. And that then will throw up a beautiful opportunity for us is, what do you do with the extra cash? These businesses and this business, at a couple of years of steady investment, once we've stopped growing and we just keep investing at a steady rate, it throws very significant cash. So that's an important offering from us.
Another one then, can you provide some context on why the performing portfolio has been relatively flat over the past 2 years? Is that just a natural seasoning of the book post-COVID?
Yeah, it's a good question. Look, I think the best way to think about it is really consumers are clearly challenged. A lot of our consumers at the moment are not entering into longer term arrangements in the way they might have in the past because they are more cautious about the outlook. So they don't want to make a commitment that they can't keep through with. So, of course, that book's paying down over time and it's holding steady. You'd expect it to start growing again, maybe when interest rates start to peel off a little bit and people and consumers start to feel a little bit more confident. Consumer sentiment across the country now is back to GFC levels. I mean, it's as low as it's ever been. And I think when those things happen, consumers continue to pay, but they also continue to keep a bit to themselves. They need the security of not having a commitment that they might not be able to keep for some particular reason. Having said that, they've been able to keep them, and we've seen no degradation in performance whatsoever over the past 18 months.
And then another one, capacity within your client service collections team to handle growth, metrics you can share there, or is that a function of the replatforming, replacing of core systems, so you can keep the same staff, but they're actually more efficient now with the new system?
Yeah. Certainly with the replatforming, our people will be more efficient. You know, at the moment, our systems are aged and legacy, and subsequently you have workarounds as things change through particular industries. We're moving to a platform that's sort of enterprise grade across the world and used by banks and some of the biggest purchasers in the world. So we expect that to increase the efficiency. Look, we've got capacity to continue buying at sort of $100 or $120 million a year without needing to add dramatically to our headcount. And over the course of the last 5 years, our headcount's actually dropped by about 25%. As we've become more efficient with those legacy systems, we expect that efficiency to continue to build out over the course of the next sort of year or so.
And then a question here on kind of KPIs for Pioneer. And you did touch on it in the slide, saying, you know, EBITDA is not a great metric for financial services business. So the attendee is asking, you know, is cash collections kind of the key performance indicator, or what would you direct people to you know, when a deck comes out, you know, what's the kind of first number they should be looking at, and then use that as a kind of really base case to judge how the business is performing?
Yeah, for sure. Look, cash collections is, I think, the best metric, because, you know, you can't cheat cash. It's either in the bank or it's not. So that's a very good metric. We were fairly steady through the COVID years at about $100 million a year in cash collections, and then, you know, we've jumped sort of 40% over the last couple of years. So really good growth there. There's that. I think EBIT's a really important number. Again, it's statutory, it's audited, and it's reliable, and then of course NPAT. But we understanding the makeup of our NPAT's clearly important. We remove or we fix that interest cost in the coming month or so, and of course that's going to open right up.